All right, welcome to another explainer where we put on our expert investment analyst hats. Today, we are taking a company's raw financial data and literally running it through a gauntlet of legendary investing frameworks just to see if it survives. We're looking at Wolverine Worldwide, ticker symbol WWW. Can this footwear and apparel giant actually pass the super strict tests of Warren Buffett, Peter Lynch, and Benjamin Graham, while also standing up to modern discounted cash flow models? Well, let's find out. Okay, here's our quick roadmap for today's analysis. We'll kick things off with a company snapshot and the Buffett lens. Then we'll move through Peter Lynch and Benjamin Graham, run a discounted cash flow along with some alternative models, and finally deliver our synthesis and verdict. Starting with Section 1, the snapshot in the Buffett lens. So Wolverine is sitting at $17.60 right now. They are right in the thick of a turnaround under CEO Chris Hofnagel, and they're leaning heavily into their active group brands. In fact, their recent Q1 revenue came in at a really impressive $457.6 million. That's up 11%. And that is largely driven by the standout performance of brands like Merrell and Saucony. Their forward earnings per share sits at $1.35, and they've aggressively strengthened their balance sheet by slashing net debt by $85 million. You know Buffett loves a moat, right? Well, looking through his lens, Wolverine actually has a pretty solid one built on the heritage and brand power of Merrell and Saucony. These are brands that just keep taking market share. Plus, management is executing a highly focused turnaround to get that debt down, which is exactly what Buffett likes to see. And look at that return on equity. Assuming a net income of $95.8 million against $423 million in equity, we get a stellar 22.6%. Finally, we can estimate their owner earnings at roughly $145 million in free cash flow. But here is the crucial point: valuation. If we calculate an intrinsic value using that $145 million in owner earnings and conservatively assume absolutely 0% growth, we get a fair value of around $20.42 per share. But as we know, Buffett never buys at fair value. He demands a strict margin of safety. If we apply a 25% margin of safety, Buffett would likely wait for a target buy price of exactly $15.31. So at today's $17.60, it's just a bit too rich for the Oracle of Omaha.
All right, let's pivot over to Section 2, the Peter Lynch lens.
Lynch always started his analysis with one simple question: categorizing a stock into one of his 6 famous buckets. To evaluate Wolverine properly, we have to ask, where does it fit? Is it a fast grower, a cyclical, an asset play? Based on the raw source data, Wolverine is a classic turnaround that is successfully transitioning back into a reliable stalwart. They just survived a really tough period, literally shaving off underperforming brands like Keds and Sperry just to stop the bleeding. And now they're actually seeing record years from core assets like Saucony. Now, Lynch absolutely loved the PEG ratio. That's the price to earnings ratio divided by the growth rate. Right now, Wolverine has a PE of roughly 13. With forward earnings growth projected around 14.9%, we get a highly favorable PEG ratio of 0.87. In the Lynch framework, anything under 1.0 is considered a fantastic value, and a 0.87 is a definitive buy signal in his book. Add in their $206 million in cash in that reduced debt we talked about, and Lynch would be very intrigued by the setup. Moving right along to Section 3, the Benjamin Graham lens and his famous defensive checklist. Graham's defensive investor checklist is notoriously strict, and frankly, Wolverine gives us a bit of a mixed bag here. It easily passes on adequate size with $1.87 billion in revenue. It passes on strong financials with ample cash. It even passes the dividend record test, maintaining a 40-cent per share payout. But it outright fails on earnings stability because of negative earnings back in 2022 and 2023. Also, its price-to-book ratio of 2.9 is honestly a bit elevated for Graham's incredibly strict tastes. To get Graham's exact intrinsic value, we use his classic formula. We take the square root of 22.5, multiply it by the trailing $1.35 in earnings per share, and then multiply that by our calculated book value per share, which is roughly $5.95. And that math gives us exactly $13.44. This brilliantly illustrates Graham's extreme conservatism. With a current price of $17.60, Graham wouldn't touch this stock without a massive drop. It simply doesn't offer the deep, historical asset-based margin of safety that he absolutely demands. Section 4. Let's bring things into the modern era with a discounted cash flow valuation. We're setting up a 5-year base case DCF, explicitly outlining our assumptions based on the data. We're starting with that $145 million in free cash flow. We'll assume a 5% near-term growth rate, which perfectly matches analyst revenue forecasts for the coming years. Then, we apply a 2% perpetual terminal growth rate, and we discount all those future cash flows back to today using a 9% weighted average cost of capital. When we run those exact numbers through the model, our sensitivity table reveals that under our base assumptions, again, that's a 9% WACC and 2% terminal growth, the fair value per share lands at exactly $21. That represents some really solid upside from today's $17.60 price tag. Even if we bump up our discount rate to a more demanding 10%, the stock still hovers right around fair value. On to Section 5, Alternative Models and Pressure Testing That Value. To make sure we aren't getting tunnel vision, let's run a couple of alternative models. First up, the dividend discount model. If we input the 40-cent annual dividend against a 9% cost of equity and assume a conservative 2% dividend growth rate, it spits out a dismal fair value of just $5.82. What this tells us, plain and simple, is that Wolverine is absolutely not an income investor stock. Its value is tied entirely to earnings and cash flow generation, not its dividend yield. But if we flip over to a comparable PE analysis, we get a totally different picture. If we apply a very modest industry average 15 times multiple on their current $1.35 earnings per share, we get a much healthier fair value of $20.25. Notice how closely this aligns with our DCF model? It suggests the stock definitely has room to run if it just trades at a normal industry multiple. All right, Section 6, let's pull all of this together for our synthesis and final verdict. The whole narrative here is essentially a tug of war between incredible momentum and heavy macro risks. On the strength side of things, Merrell and Saucony are absolutely crushing it, direct-to-consumer sales are expanding rapidly, and debt is melting away. But on the risk side, you can't ignore a $60 million unmitigated tariff impact. The U.S. market reset for Sweaty Betty is going to be a near-term drag, for sure. Plus, a recent shareholder proposal highlighted some severe climate-related supply chain vulnerabilities, basically pointing out that extreme weather in manufacturing hubs like Vietnam poses a very real material risk to future margins. Looking at all our models side by side reveals a truly fascinating split. Strict value investors looking at historical assets and demanding deep safety nets, I'm talking about your Buffetts and your Grahams, they need a price drop to somewhere between $13 and $15. Meanwhile, the growth-oriented and forward-looking models, like the DCF, the comparable PE, and Lynch's PEG ratio, all see significant upside pushing toward the $22 to $21 range. So, blending all of this together, at $17.60, Wolverine is a solid hold. It's a beautifully executing turnaround story with some genuinely great brands. But if you're a conservative investor, you should probably wait for a dip closer to $15 just to satisfy those legendary gurus and bake in a proper margin of safety against those looming tariff and supply chain headwinds. Which brings us to the ultimate question. It's really a battle of momentum versus history. If their active brands just keep taking market share and launching huge hit products like the Saucony, Endorphin, Azora, will the broader market ever actually let this stock drop to a true value investor's dream price? Or are the old-school value metrics simply too slow to catch a turnaround while it's in motion? Honestly, that's the question you have to answer for your own portfolio. Thanks for joining me on this explainer, and keep learning.